Hi, we are now in section 6 and we are going into measuring risk. A key objective of this lecture is to focus on measuring risk in the types of financial assets that we want to invest and how we measure and analyze the risk and return. And we will explore more about the relationship between risk and return. And also we'll be looking at the effect of diversification on risk. And finally, we will look into portfolio efficiency. Now we will look at what is a investment return. Investment return is looking into what we will get back in exchange for investment. In another word, it is simply the reward of your investment. If you put in some money into a certain investment, after a certain period of time, you would like to analyze what is the reward for putting up with this investment. It can be expressed in absolute monetary terms or relative percentage term. Percentage is more meaningful because a lot of investors is used to comparing the different return from other mode of investment in percentage. The analysis of return will tell the investors whether they have maximized their return or not. Usually the numerical comparison will help to let the investors understand whether the investment return has been performing well over the years or comparing with other portfolios or other investments. We will explore how to calculate a return by using examples from our investment in financial asset, which usually have a price that we can utilize in the formula. And that price usually reflects the return and the risk of the asset. For example, if you're looking at share, they have two different type of value or price. There's a nominal value and there's a market value. Nominal price, market price. And if you look at the market price, usually based on your understanding on maximization of shareholders' wealth, the share price actually reflects the value of the organization. If there is an increase in price from the date you bought, from the purchase price, then you will make a return. And the return is actually the difference between the purchase price and the sales price. And because when we are talking about shares, we will also expect sometimes when you invest in shares, we could expect dividends if the business meets the expectation and if business performs well, and that expectation will give rise to dividend. So if profits are made, shareholders may get dividends. Sometimes the management may declare dividends twice a year: interim dividend and final dividend. This is the formula we calculate the return on the financial asset. and we are actually using the share price and dividend. Let's try the lecture example to better illustrate what this formula can show. These are some of the examples I've shown in tutorial 2, but because I'm arranging this video in accordance to each respective topic, I will discuss it here as well. If you look at lecture example A, we have January, February, March, average price of share £8, 8.25, 8.6, and the return 3.1%, 4.2%. How do you calculate this? It's actually based on the price. Yeah, if you look at the price that is listed here, they are increasing. The moment the price are increasing, you will make a return. Let's look at how we calculate the return. You have the month, January, February, March, and you have the average price. 8.25, 8.6. Yeah. Now a shareholder, when he buys the share, he will earn two different types of return. Either he will get a dividend or capital gain. A capital gain is simply the price of share that he purchased. If he buy earlier at a low price and he earn increase in price, say 100, and the price increased to 120, he will earn a difference of 20. This is what we call the capital gain. Yeah, so this is his original investment. Yeah, if he also earn a dividend of £10, then what is the total of the return he received? It will be these two. So if we can formulate a formula on the return, it can include the difference in the share price, the latest price minus the earlier price, latest price minus the earlier price, divided by the original earlier price that you purchased, plus dividend, yeah, and if you express in percentage, this can be used to calculate a return. So if we look at the example here, there's no return, there's no dividend, so we can just use P, the earliest price minus the last price, divided by the last price. So in this case, for January, there's no last price. February, yes, it will be 8.25 minus 8 over 8. Here will be 8.6 minus 8.25 over 8.25. This will give you 3.1%, and this will give you 4.2%. And it will be meaningful if you quote a single return information rather than these two to the investors. So here we can calculate what is the average return. Average return, add these two figures together, divide by your calculating average for these 2 months, so divide by 2. So your average return shows that you're going to get 3.65% or 3.7% for the financial asset, for the shares. That's how they get the answer. I'll next look at page 4, practice example A 1 and 2, where you're given Q1, Q2, Q3, Q4, 4 months with the price, right? The average price, and to calculate the return, you can't do it for first year, there's no last price. Second year, yes, 14.36 minus 13.13 over 13.13, 13.85 minus 14.36 over 14.36, 15.45 minus 13.85 over 13.85, and from here we can determine the percentage. That's 19.37. Small figure less bigger amount, you have a negative 3.55 and 11.55. So to calculate the average, $17.37, 3 years, sorry, 3 months, and you should get 5.79. This is the average return. So from what we can define here, the average return is the simple mathematical average of a series of return that you calculated here, generated over a period of time. So an average return is calculated the same way a simple average is calculated for any set of numbers added together, and then in a single sum, and the sum is then divided by a count of number in the set, which is the 3 months here, to get average per month. If you look at the practice example 2 now, suppose you purchase a share of stock at the beginning of the year at the price of £20 per share, and the stock pay a dividend of £2, and the market price of the stock is 25 at the end of the year. So stock at the latest price at the end of the year is 25, and the beginning of the year the last price was 20, and in this example you were given a dividend, and they say the dividend is about £2. So what is the return? There are 2 returns here. If you notice, the first one is the dividend, the second one is the gain you made from the increase in the share price. So a return formula which we generated just now is the latest price less the previous price plus dividend divided by the previous price. It shows you the gain you make plus the return you get from the dividend over the original amount you invested in the purchase price. So it will be 25 less 20 plus 2 over 20, and you should get 35%. So let's go back to the slides where I've shown you the how to generate the return from this formula. The reality of investment risk. Well, when it comes to risk, there is a reality check. If you look at the investment we have in our market today, all of them carry some degree of risk. Shares, bonds, mutual funds, even exchange traded funds can lose value. Sometimes even more than 50% or even more than 80% it can happen if the market condition become bad. Even conservative insured investments such as certificates of deposits issued by a bank or credit union also may come with inflation risk. They may not earn enough over time to keep pace with the increased cost of living. So what is risk? When you invest, you make choices about what to do with your financial assets. Risk is any uncertainty with respect to your investments that has the potential to negatively affect your financial welfare. For example, your investment value might rise or fall because of market conditions or market risk. Corporate decisions such as whether to expand into a new area of business or merge with another company can affect the value of your investment. And that's business risk. Yeah. Or another word, the unsystematic risk. If you own an international investment, events in that country can affect your investment, and that's political risk and currency risk. Yeah, so all this we can actually recall from the earlier diagram I'm showing you. This diagram. And generally, risk can be divided into two areas. Now, we know the unique risk can be diversified, or unsystematic risk can be diversified away. And when you diversify, instead of buying one security, you buy a group of securities which is known as portfolio. You will see that the risk will drop, especially if they are from different industries. But when we have a systematic risk or market risk, this risk cannot be diversified away. So in most investment, let's go back to the diagram. You can see that this is a number of securities, and this is the total portfolio risk. Okay, let's go to the slide. So for those areas that we can't diversify, it would be within the interest of finance to actually measure them. So one way to measure specific risks is to look at possible outcome that could be different to the expected outcome. And this is where we can use standard deviation. Yeah. So basically, standard deviation is a number used to tell how measurements for a group are spread out from an average mean or expected value. And when we apply the standard deviation in calculation to find risk, a low standard deviation means that most of the numbers are very close to the average. A high standard deviation means the numbers are spread out. High standard deviation shows that it has more fluctuation. It shows volatility. That means high standard deviation will be risky. And I mentioned here in the slide, the greater this is the sigma symbol, represents standard deviation. The greater the sigma symbol is, the greater standard deviation, the greater the spread of possible returns, the greater the risk. So investors' best guidance, always try to choose assets with lowest risk but yield greatest return. Let's look at some example how we're going to calculate variance and standard deviation. Let's look at the tutorial 2 slides that better describe what is variance and standard deviation. I have already included this slide in tutorial 2 folder. If you open the slide, it will give you some explanation on the risk and return. Risk is the potential variability in future cash flow. The wider the range of possible events that can occur, the greater the risk. Yeah, it actually measures future cash flow coming to your business, and analyzing this cash flow, if you find that it is volatile, the business is not concerned, it's more concerned with let's say you open a restaurant, there's a walking customer, your profit depends on the number of people that walk in and dine in your restaurant, and a lot of this depends on the how you promote your restaurant, how good is the food. So the sales revenue is quite uncertain. You won't know tomorrow how many people will come, and if your location is not a good location, one day you can have very high sales, second day you can have very low sales, then there will be a fluctuation of this cash flow coming to you. Then your business is high risk. But let's say if your restaurant now has many fixed customers who are there to give you business, they are your relatives like your father, who prefer to have their breakfast in your restaurant every morning. So now your business has a fixed range of customers coming in every morning that can contribute the certain amount of revenue to your business, and a lot of this will not be uncertain. Level of uncertainty will be low. Or if your restaurant has signed a short-term contract to provide catering services to nearby offices, every day there's a fixed order of 200 breakfast set in the morning, then your revenue will be fixed. There's no more variability of return. Your cash flow is certain to come in for a certain period of time. Then your business will have low risk. There's no volatility. And that is when we will say your business is more stable. So understanding the concept and definition of risk just now, we can actually use our knowledge of standard deviation and variance. So understanding variance and standard deviation can be used to estimate risk, as volatility is the standard deviation, which is the square root of variance. Volatility measures the fluctuations of a process. I'm going to show you in calculations later, don't worry. But in order to know volatility, you need to know the dispersion of the process. Variance actually show the dispersion, the measure of how dispersed returns are about the mean. You already learned how to calculate the average return. That is the mean. So from this middle line, Variance show how dispersed are the returns, possible returns affected, and then after you calculated variance, you can determine the standard deviation. From each of these dispersed unit, what is the volatility? Variance, remember we have to calculate variance before standard deviation. Variance is given by sigma to the power sigma square, yeah, and after you calculated variance, you have to square root it to get standard deviation. This is the formula for standard deviation. R minus R bar to the power of 2 times the probability. The definition is given here. R is the respective return, rate of return for individual month, and the R bar is the average return. P is the probability, and this is how we calculate the standard deviation. Yeah, volatility or standard deviation is the square root of variance and has the unit in percentage. This change in unit makes volatility more interpretable, more comparable, and it is a better tool for analysis. Let's look at some lecture example which I have covered in tutorial 2. This is the lecture example B in your session 6 lecture example, page 1. You have 100,000 with you and you want to invest in either A and B. Past data for returns are given for A and B 2005 to 2008. A and B returns is listed herewith. Which one do you choose to invest? Now remember, this is a single asset. You choose to invest either share A or share B. You cannot choose both. You choose only one, so you can use the formula. Let me show you the workings. Remember, this is the standard deviation formula for single asset. R minus R bar times probability. In the question, we don't have probability, so we can determine standard deviation from here. Now, they give you 2005, 2006, 2007, 2008. And the return for A, So this formula, return for A is given to you in percentage. This is the return we're talking about. Now the next step in the formula is to calculate R bar, which is the average return. To calculate average return, we simply add these together. It will give you 18.75. There are 4 years. Average of this you add together will give you 75%. You need to find what is the average return. Average return is this whole thing divided by 4 years. So over 4, your average return will be 18.75%. So now, based on this formula, we can actually construct a table to calculate your variance and standard deviation. Yeah, this is average return, and all these are your return from respective period. So if you put them in a table, 2005, 2006, 2007, 2008. Yeah, return for A, this is share A, 15%, 25%, 10%, 25%. Average return for A you calculated is 18.75. So put it inside. That's average return. R minus R bar for A. We are doing this step because this is the next step in your formula. You have R, you have R bar. Now you have to calculate this R minus R bar as shown in this formula. So take this minus this, this minus this, this minus this, this minus this. Here you go. And the last part here, there is to the power 2, square 2. So we have to do this now, square. So we take the whole amount, square, 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 and you get this. The total 168. So this is your variance, or the dispersion, yeah, which is also given by sigma squared. That's why you have to calculate, when I said earlier, you have to calculate variance before standard deviation. Standard deviation is just square root of variance. To the power 2, bring here, you square root it, 168.75, and your variance and your standard deviation is 12.99. So if you do the same for B, you're given 15, 16, 14, 17%, total 62%. Divide by 4, your average return for B is 15.5%. Yeah, so construct another table. For this is B, and the next step for standard deviation formula is the square root of summation R minus R bar to the power 2 times probability. We are just looking at these two without probability since there's no probability. So R minus R bar, you're going to get the following. And now square it, you get 0.25, square this, you get also 0.25, square this, 2.25, 2.25, in total 5. This is your variance. So standard deviation is square root of variance, you get 2.24. Now what does this standard deviation 2.24 mean? It means your investment has an average return of 15.5%, and if you have the variance, if you have the standard deviation, it will be plus minus 2.24%. It means the range is now determined. It means this is the range. So if the investment gets into the worst possible situation, yeah, negative outcome, worst possible situation, the lowest return you can go is 13.26%, but in the best possible situation, it can reach up to at least 17.74%. The advantage of this is you are now more aware about the range, more informed about your return, based on the return, how far it can fluctuate away. Yeah, the best possible result, the worst possible result. So this range will give an indication of comparison purposes for you to make a better decision. You can try another example on page 4. Also single asset with A and B. And now since you have well versed with how we derive the standard deviation formula, I can just show it to you. What you have seen in this example is the years, the return given to you for two shares A and B. This is the return. So first step, calculate the average return, which is the mean. Add all this together, divide by 4, you should get 15%. Add all this together, divide by 4 years, you should get 15%. So do like what you have done. You can actually list down the years, the return for A, the average return that you have calculated, then take R minus R bar. This is the R minus R bar. Square this figure to the power of 2, you get this. Add all this together, this is your variance. Square root your variance, square root it, you get standard deviation. Same thing you do for B. This is the return, and this is the average return. Take this minus this, you get this figure. Power of 2, this is variance, this is standard deviation. Now let's do a comparison. I just put down the summary as once you calculated the standard deviation and the average return. Just put down the summary here. What we can do is we can further analyze this by taking standard deviation over the return, and that's 18.71 over 15%, 4.69 over 15%. This is what we call the coefficient of variation. Coefficient of variation actually measure for every 1% return you invest, what is the level of risk you are exposed to. If you solve this, you get 1.25. You solve this, you get 0.31. This analysis is important. It shows that between these two financial assets, the return is the same, not much different, but the risk for B is so much lower per 1% return you invest. So best the investment to invest is always B. Remember, finance, we want to maximize the shareholders' wealth, so always maximize the return. Both these two are the best possible return you can get in A and B, and minimize the risk. In these two, B has much lower risk, so best decision is choose B. Same return but lower risk. Let's look at another example for single asset, but this time using probabilities. if you follow me, let's go to page 6. Practice example D. And this question, you're given the economic condition for wait, let me check. Sorry. Okay, we can still do this question. The figures given were quite similar with what we have done just now, the return. And we were required to calculate the expected return and then which investment would we recommend and why. Yeah, so with this probability, we now will have to calculate the standard deviation. Yeah, it's still a single asset for the reason because of there's no weight given. We're going to study this in portfolio later. We'll treat this as a single asset because there's no combination of shares that you were told. So we're going to calculate this as an individual. So we can use the single asset formula. Let's look at this example. So this is lecture example 6. Return was given for share M. I just copy it down. Share M, share S. Yeah, and the probability. So we're required to calculate the standard deviation. First, we have to calculate the expected return. And expected return is quite straightforward. When there is a probability, let's try with share M. So to find the average return for share M, you just take the probability times the return. The rationale is quite simple. To get this return, 25%, there's only 25% chance. So the average return would be 25% chance of this probability will get you this time this 6.25%, 4.5%, and there's a negative here, -5 times 30% probability. So 30% chance you're going to get 5%. So the average return is 1.5%. Yeah, this is the average return. So what you can do now is you add them together. The average return is 9.25%. Yeah. Now your formula for standard deviation is square root of r minus r bar to power 2 times probability. Now we have probability. Let's calculate standard deviation for share M. So this is average return. These are the return. Let's put them in the table. So copy down the return, the average return from here, and the r minus r bar. This is required by the formula. So this is what we're going to resolve. Take this minus this. Left minus right. Left minus right. You're going to get these figures. Now we need to square. So square this figure, this, and this. What you get? You get around 248, 0.56, 203.06. Now you have probabilities in this question, so this part you're going to add the probabilities into it. 25%, 45%, 30%. The formula requires r minus r bar squared times probability. So the answers you got here times probability. This will give you the variance. This time this, you get 3.8. This time this, you get this time this equals 2.02, this time this equals 0.25, and this time this you get 60.92. So the variance is 123.19. So standard deviation is square root of your variance, 123.19, which is 11.10. This is standard deviation for share M. Do the same thing for share S. Take the probability times return for share S, you get this. Probability times return for share S, you get this. This will be your average return for S. Probability times return for share S, you get this. Add all this together, average return for S is 8.9. Yeah, so copy the table down. Boom, moderate recession for economic condition, return for share S, and what we calculated just now, the average return 8.1. Then R minus R bar, you get this as per the formula. R minus R bar, you get this. R minus R bar, you get this. To the power of 2, because the formula requires you to square it. Yeah, and then there's probability. Your formulas requires you to calculate the probability. Okay, so times the probability, get variance, add together. This is your variance. Square root this figure, you get standard deviation. So the summary, standard deviation is your risk, 11.1 and 2.59, 11.1, 2.59. The average return, M and S, 9.25 and 8.1, 9.25 and 8.1. This is where we analyze. You can also calculate coefficient for variation to analyze this figure. Yeah, the return is not so much higher difference, but the risk is a lot. If you calculate coefficient for variation, S will be the ideal investment. Yeah, and also if they ask you the theory question, what will you recommend as the best investment choice? Well, there's a lot other issues that you can consider, and much of them could be qualitative. For example, the risk attitude of your owners, whether they can take risks or they are worried about taking risks. And if you look at the probability of condition, this economic condition, how do they arrive at the probability? How accurate are these predictions. These are the things that you can actually consider to put in at this part. Let's go back to the slide. Portfolio. What is a portfolio? Portfolio is a collection of investment. That means they are actually a group of financial assets that you bought, which can include stocks or bonds, etc. etc. The use of portfolio usually is, for example, if you want to limit your risk and not have to worry about one bad thing ruining you, then you need a diversified portfolio. So sometimes when we analyze shares, for example, in the market, there are some shares have high risk, there are some shares that has a low risk. An investor can take a stand, for example, instead of going to one corner taking all the low risk, or going to the extreme corner taking all the high risk. Investor can actually make a position where they can take combination of shares that has low risk and high risk together to maximize the return. Yeah, and the combination of this investment, we call it a portfolio. So when you see this in the finance, usually they will give you information about how the investment was divided into two different financial assets. The division of investment in these two different investment is known as weight. So if you want to find a return of a portfolio, which is actually 40% times the return A, if the weight is 40% in return A, yeah, and 60% in return B. Standard deviation is given by this formula. Standard deviation is the weight to power 2, weight square, standard deviation for first investment to power 2 plus weight of second investment times standard deviation of second shares to the power 2 plus 2 times weight 1, weight 2 times covariance. Now, what is covariance? Covariance actually measure the relationship between two shares. Remember, portfolio is a combination of investment now. When you talk about portfolio as a combination of investment, the standard deviation, we cannot use the formula which we learned just now. It's more for a single asset. For portfolio, when you have two assets, we also have to look at their relationship between each investment. So if you have two risky assets that move in tandem, so when you have positive covariance, it means assets are moving together. They have a same relationship. When you have negative covariance, that means assets are moving inversely on the opposite direction. So when you have covariance, remember the return of the portfolio requires you to take into account of the weight, and second, when you have the standard deviation, it requires you to take into account of covariance. Let's look at the example now. Now we have calculated a single asset on page 1. We calculated the return and the standard deviation. Now if we continue from this example to page 2, now the investors decide to hold two shares, A and B. Same question continue, but he decided now to invest in both shares. The weight is given 40%, 60%. Okay? There's something I need you to do. There's a typo here. It should not be correlation. Please change this to covariance. Yeah, please change this to covariance. Now, let's look at what we're going to do now. When you have a single share, that means you either buy share A or share B. Standard deviation formula is R minus R bar to power 2 times probability, then square root. For portfolio, you buy both shares, A and B. How many percent A, how many percent B is your weight. So if you're given that, your average return is this formula. Weight A times return A plus weight B times return B. Yeah. Let's say you're buying share A with 40% of your investment, then your weight here will be 40%. 40% of your 60%, the balance is purchased with share B, then the weight B here will be 60%. Yeah. Standard deviation also follow a different formula. Standard deviation for portfolio AB. I mean standard deviation for portfolio 2 shares is given by this formula. You can't use this. If they give you a weight, then this formula have to be used because your investment now is in 2 shares. Weight to power 2, standard deviation for first asset power 2 plus weight to power 2, standard deviation to power 2 plus 2 weight A, weight B covariance. So if we look at example C2, page 2, this is the information given. Average return we calculated for share A and share B. Now they don't buy single asset anymore. They buy both. Question tell you 40% goes to A, 60% goes to B. And standard deviation for single asset is given. Can we calculate what is the standard deviation for portfolio? And also the expected return, average return for portfolio. So average return portfolio, weight A given to you is 40% times return A 18.75 plus weight B 60% times return B 15.5%. Your answers will be 16.8%. Now standard deviation. Standard deviation is given by portfolio formula. AB is weight A power 2 standard deviation A power 2 weight, standard deviation B power 2, 2 weight A, weight B, covariance. Weight A is 40% squared, standard deviation 12.99 plus 60% power 2 times 2.24 covariance given to you at positive 0.5. So solve the equation. 27 plus 1.8 plus 0.24. So square root of, add together 29.04. Your variant, your standard deviation will be 5.388. So remember, portfolio, the key to answer this question is make sure you use the right formula. Combination of investment A and B is portfolio. This is the formula to find the standard deviation. Here must be covariance. Average return, this is how you calculate it. Yeah, we're going to try a final example much later where you're going to be given correlation. Correlation you cannot just add in inside. Yeah, I'll show you later. You can try another example on page 4, practice example C. Same thing. This is not correlation, it's covariance. Okay. This is the information. The return 15%, weight, non-investor buy 70% of stock A and 30% of stock B, standard deviation. So to find expected return, you just take weight A and weight B. So expected return for portfolio is weight A times return A plus weight B times return B. You are told that it is 70% and 30%. Return A is 15%. Return B is also 15%. Add together is 15%. Standard deviation is square root of weight A power 2 times standard deviation times B standard deviation times 2 times weight A, weight B, covariance. This question, your weight A is 70%, standard deviation you were given 18.71 square plus 30% times 4.69 plus 2 times 70%, 30%, but this time covariance is -5. So make sure this part becomes negative now because the covariance is -5. This is the second part, this is the first part. So you should get 171.5 plus 1.98 plus 0.21. Make sure you know how to use the function for square root in your calculator, and you should be able to get 13.16. That is the standard deviation for portfolio AB. Let's go back to the original slide. We have done this, so we have calculated the standard deviation. Diversification. In fact, diversification is the process of allocating capital in a way that reduces the exposure to one particular risk, which is known as the unsystematic risk. A common path towards diversification is actually to reduce risk of volatility by investing in variety of assets. If, for example, in shares, you choose different industry. You can also choose combination of shares and bonds, for example. The reason is to avoid putting all your eggs in one basket. In case of one share from one industry is affected, your other investment in other industries will not be affected. And this leads to the term portfolio, where you have variety of investment. We have also done this in a portfolio. When you measure expected return, portfolio has two assets. So how you divide your investment in the asset by weight, it must be shown. Yeah. Okay. We also have seen the portfolio returns, and we also have seen the standard deviation. Here I add some explanation on volatility, because in finance we treat variation of future cash flow coming in is risk, and since standard deviation are able to measure volatility and variance are able to measure the dispersion, we can actually use it to measure the risk in finance, statistical risk with the symbol sigma. Now, this is the how we look at the standard deviation. Another definition I give you here is a measure that is used to quantify the amount of variation or dispersion of a set of data value. Low standard deviation indicate low, close to the mean, low risk. High standard deviation, high risk. This is the dispersion, and from the dispersion we can look at the volatility of involved of the data. Yeah. More explanation here on the variance, and from variance you can get standard deviation. We have done all the calculation for this part. This is the formula, and portfolio variance has different formula. This is the portfolio formula for portfolio variance. Yeah, and then to find standard deviation, you just square root the variance given to you at covariance. We're going to look at this later. This is actually when correlation is given to you. Yeah, you have to convert it. Alright, we have done all the calculations. Now let's look at efficient frontier. Efficient frontier, sometimes they are also known as a portfolio frontier. It's actually a finance concept. consisting of a modern portfolio theory introduced by Harry Markowitz and others in 1952 in the US. It is, if you look at the diagram, they give you is a combination of portfolios in the market, and they tabulate it in the graph and analyze it. The graph has two axes. One is the standard deviation. We already apply standard deviation, so he's using standard deviation as a measure of risk and the expected return. And he explains that most market investments fall within this area. Yeah. When you have certain risks, you will have a certain return. And from the range of investment that you have, the best one were at this side. But you can't go here. The reason is you can, but it's difficult. The reason is because these are very super efficient investment. Everybody's looking for the investment in this area. If there is one or two, everybody will come and snatch it. So you will see that investors, they want to invest projects that are moving towards this direction. The best investment are around here. These are super efficient investment. These are less efficient investment. So according to Markowitz, if you put together all the available investment, the investments that is located close to the super efficient, where you have the group here, is positively sloped like a parabola, and this is where the best available investment is available. Here is where we call the efficient frontier. The most efficient investment actually lies on this frontier, which is possible to obtain if you do sufficient analysis, or you do a combination of investment of your portfolio to maximize your return. According to Markowitz, this parabola actually reflects the typical risk attitude of investors. High risk, high return investors like to be here. Low risk, low return like to be here. Yeah. So there is a possibility that if the investors could combine two different investments here into minimizing risk and maximizing return. For example, the risk averse people, if we can combine some risky investments, his position would have moved closer to this point. This is where the most efficient frontier lie, and the best is at the tangent of this point. If you can arrange a portfolio to meet the opportunity available and match to get investment in this point, then your investment will be a efficient investment. It will lie along this frontier line, and the best efficient investment is actually at the tangent of this line. This parabola graph will be shaped in such a way when there is no risk-free asset available. But when there is a risk-free asset, then the efficient frontier line will be a straight line. Yeah, when you cut over here, this is the risk-free rate. For example, the treasury bill rate. So this line is easier to define. Anything below this line is then inefficient. Anything above this line will then be efficient. Anything on the line will be efficient, super efficient, efficient, less efficient. If there is a risk-free asset in the market, this line will be your efficient frontier. If there's no risk-free asset in the market, then all your investment will curve like a parabola. Yeah, and they are all moving to this direction. The best investment is the super efficient investment. So everybody is seeking to move towards here, and if you are looking into the investment, this group of investment will be the current available investment in the market. Yeah, if you are investing in any one of these assets, then you are inefficient, because a better one are still available along this line. You can search for this, or you can mix your portfolio to reach here. Yeah, and if you can find investments or create investments that is located along this line if the market has no risk-free asset, then your investment is considered a efficient investment. And of course, there are super efficient investments, but it has certain conditions attached. It's not easy. For example, government can sell a contract, put a high price, high return investment, but selected few can get their hands on it. In general, this is what the market can get, and this is where you are. So McCovey say in that kind of position, you can do your best to mix your portfolio to minimize your risk and maximize your return to come over here towards the tangent on this parabola to get the best investment. Yeah. This is description of the efficient frontier based on what I have discussed just now, where returns are maximized for given level of risk. Choose portfolio mix that lie on the efficient frontier to give maximum return for given risk. Yeah, I explain again. Low risk, low return. High risk, high return. Don't just stuck here. You didn't maximize your return. Here you didn't maximize your risk. You emphasis on high risk. You didn't take your position to safeguard your investment. Here you overemphasis on risk. You didn't emphasize on return. So if you can mix your shares, you can actually come here. Yeah, instead of this area, you can actually come here to maximize the return. Right. This is a downloaded note on efficient frontier as an article. I left the website address at the article page in this folder. You can also look at it. Here it explains that this is the efficient frontier in a clearer diagram. Yeah, it explains that based on your understanding in standard deviation, you know that every investment has risk, and standard deviation measure how far away this variation from average return affects on the investment. So the collection of the securities can be tabulated in this graph. It's clear for any given value of standard deviation, you would like to choose a portfolio that gives you the greatest possible rate of return. So you will want portfolio that lies along the efficient frontier around here. rather than lower down. This is inefficient. So if your investment is located somewhere here, then you should find ways to move it somewhere along the graph, or abandon it and find another one along the efficient frontier. These are where the best portfolios are. Above this line are super efficient. It's not easy to find in the market. So the second property of efficient frontier is that its curve is not straight. It's actually significant. In fact, this is the key to allow diversification and let you improve the reward to risk ratio, assuming that there are high risk security, high return, low risk security, low return, and if you can get a mix, you get a position somewhere in between here. If you are from this group and you take a mix by taking more risky asset, you improve your return. Yeah, by taking just additional low level of risk, your position is improved. Whereas if you are in this position, you're taking high risk, high return. By taking a mix of the share from here, you will improve your risk position. Your risk level will drop. Although your return may drop, but it will not be that significant. This shows that indifferent curve actually help you to allocate the efficient portfolio, looking at maximizing return and minimizing risk.